This a new weekly outlook for week 43, from October 20th to 24th, 2025. Let's kick off with the weekly executive strip chart and set the tone for the week. My bias is moderately bullish because there was no follow-through bearish bar after the significant bearish bar on October 10th, and the market is still behaving like an expanding triangle that signals indecision rather than control by one side. For this week I am focused on the range from 6420 to 6800. The top of that window remains the 6800 level, a robust resistance that has mattered before. After a sharp decline that never produced sustained bearish momentum, the market formed a converging triangle, which tells us both sides are testing and waiting. If we do not see a second strong bearish leg that tags the important zone next week, which blends another slightly flattened trend line with a shifting trading range area, the odds tilt a bit toward an upward move to retest 6800, and that would be the battleground level. Underneath, I am treating the low of the large bearish bar around 6540 as soft support. The hard support sits in the 6400 to 6420 zone. If that zone fails to hold in the coming weeks, the bullish trend could break and the probability of a slide toward 5,000 increases, although that kind of distance is unlikely this year. On the macro side, the calendar highlights a GDP release on Thursday, and that can add volatility inside the current structure. For Monday, I will trade it like a range-bound market with a slight bullish tilt. I am prepared for a gap up or a gap down, but after last week's converging triangle, the first pushes may not show strong trend behavior. If we get a gap up, I will only consider a long after a gap up above 6,700 with 2 consecutive bull bars, and I prefer to see a retest of the trend line and then use the second entry for the actual trigger. For a detailed walkthrough of the logic behind that, I will reference the section on last Friday's 5-minute chart analysis later in the show. If we get a gap down, I will look to short below the first bear bar only if it closes on its low, and I will manage with trailing stops so that I can let the trade breathe inside this range. In short, I am entering the week with a measured, slightly bullish posture, eyes on 6,800 above and 6,400 to 6,420 below, and I am ready to adapt around Thursday's GDP, which leads us naturally into the broader monthly outlook. Now let's move to the monthly outlook chart and connect the larger context. The trend here is neutral, which means I am reading the tape as balanced rather than directional while it decides how to resolve prior extremes. The pattern mix includes a parabolic climax, the top of a bullish channel, a 50% pullback, and the combination of a higher high and a lower low. That mix often leaves price hunting for equilibrium. The monthly chart remains relatively clean and still far from its 20 EMA, which invites mean reversion impulses but does not guarantee them. The pivot that keeps drawing the eye is the 50% pullback from the September monthly bar at approximately 6,566. That level was tagged on October 10th and is marked by a blue line on the chart. After the tag, there was no bearish follow-through, and buyers have been attempting to lean against 65.66 to initiate new long positions. With 2 weeks left in the month, the closing location becomes critical. If bears cannot close the monthly chart below 65.66, the market is more likely to resume a bullish trend from this higher time frame. Said differently, a bull bar or even a neutral bar that holds above 6,566 tends to keep buyers confident that the prior up move is intact. Conversely, a drop into the 6,400 to 6,540 neighborhood would be a stronger signal that bearish momentum is returning, because it would pull price into the bottom end of the recent structure and ask buyers to defend again at progressively lower ground. On the resistance side, 6,800 remains the key ceiling. Without significantly bullish news, momentum does not look strong enough yet for a clean and sustained break above that level. Remember that 6,800 has been tested and respected, and in a neutral monthly environment it will probably require more than routine flows to push decisively through it. On support, The spotlight stays on that 50% pullback at about 6,566, which is where dip buyers showed their hand. From an Al Brooks price action perspective, a parabolic climax near the top of a channel often leads to a phase of sideways to down trading, and a higher high coupled with a lower low produces an expanding triangle feel that keeps swings broad and tricky. That is exactly why the neutral label fits. The implication for trade planning is straightforward. Until the monthly bar closes below 6,566, bulls have the benefit of the doubt on the higher time frame, but they still need to prove they can work through 6,800 rather than just poke it. Bears, meanwhile, do not have control but can continue to lean on that ceiling and try to push price back toward the 6,400 to 6,540 zone. My takeaway from the monthly chart is simple. Hold the map of 6,566 and 6,800 in mind and expect a two-sided tape inside that band, which sets up the bridge to our weekly outlook. Shifting to the weekly outlook chart, I see a neutral to slightly bullish environment, and I will explain why. The pattern in play is a converging triangle, and the most recent weekly bar closed above the 50% level as a bull bar, finishing in its upper third. The market also closed above the low of week 40, which closed the potential bearish gap and took away a source of bear narrative on this time frame. Put that together with what happened in week 41. After a strong bearish bar in week 41, last week closed as a bull bar, which signals a lack of bearish follow-through and a potential reversal attempt on the weekly chart. Bears need to deliver more momentum if they want to demonstrate control. In other words, one strong bear bar that fails to get followers is usually not enough. Closing back above the low of week 40 shows sustained bullish effort. Combine that with the converging triangle and the absence of a strong second leg down toward the 20 EMA, which aligns with the bottom of the key zone highlighted as a red box, and there is no clear evidence of a new bear market developing in the next few weeks. For traders who anchor their decisions on the monthly, weekly, or daily chart, long positions remain favored when the market offers reasonable setups, because the tape has defended prior lows and continues to hold above important midpoints. Now for the levels to watch on the weekly chart. Resistance spans from last week's high of 6,766.75 to the all-time high of 6,812.25, and that band is where I expect responsive sellers to test bulls. Support spans from last week's low of 6,571.25 to the low of the large bearish bar in week 41 at 6,540.25, and that is where I look for buyers to show up if the market dips. Tactically, within a converging triangle, I expect breakouts to struggle and pullbacks to be choppy, so I keep my trade size modest and I am quick to take partial profits at obvious magnets. If bulls can auction through 6,766.75 and press towards 6,812.25, I will watch for signs of absorption rather than assume a one-way push, because the structure still says neutral with a slight bullish tilt. If bears can push back towards 6,571.25 or even 6,540.25, I will watch for rejection and second entries that fit the broader theme of buyers defending pullbacks. The weekly takeaway is this. Momentum is attempting to turn up but remains inside a converging triangle, so I will stay patient and let the levels do the talking, which sets up the more tactical daily outlook. On the daily outlook chart, I am keeping the label neutral. The pattern here is volatility with a clean sideways box, plus early signs of a bearish reversal that do not yet have momentum. We need more bars to confirm any next significant move. The most notable feature from last Friday is the long bottom tail that formed in pre-market with relatively low volume. I will walk through that dynamic in the 5-minute review, but the key point is that bulls continue to be resilient and have prevented a full trend break. We still have the significant bearish bar at 6,540 that has not been retested and that lacked follow-through when it printed, and that continues to suggest the bullish trend may continue on this time frame. The challenge is not whether price can go up from here, but rather how far it can go before meeting real resistance. That brings us back to 6,800, which has proven to be a strong resistance and is associated with a robust bearish bar at the top of the monthly trend line. Because of that overhead weight, I expect range-bound trading to persist for 1 to 2 weeks, with both sides taking turns but neither side sustaining long runs. Practically, that means the up and down movements should line up with the levels already outlined in the monthly analysis, and that favors a quick decision style. On the daily chart, I like a buy low and sell high bias for scalps inside the band, and I will be strict about taking profits at prior bar highs and lows, midpoints, and the obvious magnets that the chart has repeatedly respected. That said, the 5-minute intraday chart can still offer solid swing trading opportunities when second entries align with the larger map. For the levels to watch, I am using the same bands as the weekly. Resistance runs from last week's high of 6,766.75 to the all-time high of 6,812.25. Support runs from last week's low of 6,571.25 to the low of the large bearish bar in week 41 at 6,540.25. Inside this framework, bulls want to keep closing above prior lows and then force tests of 6,766.75, while bears want to push price back down to 6,571.25 and make buyers defend again. My daily takeaway is this. Expect two-sided action, trade the edges with quick hands, and get ready to drop to the 5-minute chart for precise execution, which brings us to the 5 minutes reviews for last Monday. Let's review last Monday on the 5-minute chart. Trading that session was challenging and the tape offered few profitable entry opportunities, but disciplined traders could still limit losses and stay in the game. The best long came at bar 21 after a double bottom and 2 consecutive bull bars. That kind of second entry long aligns well with Al Brooks' principles because it shows buyers willing to try again at a price level that just held. The problem on Monday was overhead friction from the 50% resistance based on last Friday, which we only fully recognized in hindsight. Using a trailing stop after entering above bar 21, you likely got taken out around bar 65 with a modest gain of about 5 to 6 points, which is perfectly fine given the backdrop. After that, the chart did not offer other clear entries with a favorable reward to risk. A short below bar 66 was viable, but it came late in the session, and intraday traders usually need to flatten by the close. In a day like this, I focus on 3 things. First, I reduce size and play defense, because difficult tapes are where risk control pays the bills. Second, I let the market prove trades by waiting for second entries or micro double bottoms and tops, especially when the first push fails. Third, I avoid chasing near resistance or support until I see strong conviction follow through. Monday was a reminder that not every session is designed to pay, and survival is a skill. The key takeaway is that patience and risk control kept us in position for the next day's opportunities, which sets up the 5 minutes reviews for last Tuesday. On Tuesday, the tape opened with clarity. If you were holding short from the prior discussion, the right exit came after bar 5 printed 2 strong bull bars near last Friday's low, which is classic evidence of buyers defending a prior reference. Entering a long above bar 5 was viable, and both a 1-time measured move and a 2-time measured move were achieved within the session. Early on, it was hard to commit to the trend if you came in with a bearish bias, but the lesson is to stay disciplined and trade what the bars are saying. If you missed the first chance, long entries above bar 27 or bar 34 also qualified, each offering a clean pullback and a fresh second entry structure. For shorts, entering below bar 62 with an eye on a retrace toward a one-time measured move made sense, but that was late in the day. When it is late, I take quick profits or cut the trade quickly because time to the close compresses the distance available to targets and shrink reward to risk. The overall feel of Tuesday was a trend from the open that rewarded conviction after confirmation. The best practice was to avoid fading those strong early bull bars and instead look for pullbacks that produced higher lows and second entries. My Tuesday takeaway is that the market shifted from Monday's hesitation into a more directional tone, and that momentum framed the setup for the following session, which leads into the 5 minutes reviews for last Wednesday. Wednesday began with a gap up and quickly printed a double bottom at a higher level, which made a long above bar 5 a reasonable choice. The catch was a high-level resistance near 67.60 that had been a breakout point during a prior bull trend. That kind of reference often forces tough decisions. If you took the long above bar 5, taking profits with a limit order at bar 8 was conservative and sensible. Holding past that point risked being stopped out, and many traders likely gave back some open profit while waiting for continuation that did not immediately arrive. If you approached the day with a bearish bias, taking profits at bar 8 on the long or flipping to a short below bar 12 were both valid moves. The targets included a gap closure and the weekly 50% pullback level, and using a trailing stop worked well as the market tested lower prices. From an Al Brooks lens, this was the playbook. A gap up that fails to accelerate and then prints a higher double bottom is bullish only if follow-through appears quickly. When follow-through is weak at a known resistance, the better trade is often a second entry short that rides a test back to the gap or to a prior midpoint. The message is to stay flexible and let the structure lead rather than marry a bias. My Wednesday takeaway is that respect for prior breakout levels and quick profit taking made the difference, and that set the stage for a more tactical day on Thursday, which brings us to the 5 minutes reviews for last Thursday. Thursday revealed its direction only after bar 23. The session opened with a gap up and retested that gap, and bulls attempted to keep the trend going but failed at bar 15 and again at bar 23, with bar 23 closing on its low. That close on the low was the tell for potential bearish momentum and turned the day from uncertain to tactical. In that context, bars 23 and 25 provided strong short entries, and the sensible profit target was near the bottom of bar 40, which lined up with the weekly 50% pullback support. Later in the session, intraday traders saw bar 46 reach the 50% bull pullback but failed to break through twice. That gave another short entry below bar 49 with the target again set at the 50% pullback area. This is textbook Al Brooks behavior. When a session hides its intent early and then shows a decisive bear bar that closes on its low, I favor second entry shorts with measured targets at obvious prior lows or midpoints. I will also scale out to respect magnets, because in a day with late discovery of direction, the market often pauses at each level where earlier battles took place. The Thursday takeaway is that patience until bar 23 paid, and once the bears showed their hand, the clean entries were at bars 23, 25, and then 49, which sets us up to examine how Friday traded, in the 5 minutes reviews for last Friday. Friday closed at its high but did not offer a clear swing setup. Even so, the likelihood of breaking below the 50% weekly pullback level remains elevated for the following week, so context still matters. For intraday trades, if you held a bias toward strong support at the weekly 50% pullback, long entries above bar 4 and above bar 26 were favorable. Note that the low of bar 26 was 1 point lower than bar 4, so a tight stop just below bar 4 likely would have been hit on that first attempt. The absence of a strong bullish trend through the day was likely influenced by a bearish trend line that kept rallies contained. There were no definitive signals that a full reversal to a bullish trend was underway, and bears did not take clear control either. In a day like this, I stick with Brooks-style second entries, I avoid chasing, and I emphasize quick profit taking at nearby magnets. The real message of Friday is that the open on Monday will be crucial. How the market behaves in the first minutes will help set the bias for the session and tell us whether the defense around the weekly midpoint holds or fails. My final takeaway for the week is that we are range-bound with a slight bullish lean. The higher time frames still favor buying dips when the levels hold, and the next fresh information will arrive as soon as Monday opens.